What I also want to look at is I want to look at that same year over year change when I'm doing this to see where we're trending, because that change is going to tell us what direction we're putting in or pointing in. So if we're at the seller's market at 1.6, where were we exactly a year prior in the same month? And we happen to be at 2.1 months of inventory in December of 2023. So we saw a 19% decline in the amount of supply, or the amount of houses that are for sale over the last year in our market. So simple, basic market economics says low supply. What do we think is going to happen to the prices? They're going to continue to rise. You're right. So those two metrics are something that I'm always looking at on a monthly basis at minimum, to try to see where the market is today and kind of where we're going. So based on those two numbers and the changes in the metrics year over year, I'd say we are in a very much a bull real estate market, with prices are going to be continuing to go up. I can be aggressive with my offers. There's probably going to be a lot of competition for deals out there, multiple offers, but I can inform my clients that this is what's going on. And so if you miss out on this deal because you didn't pay $10K over asking price, the price is going to go up 12% next year. So you're going to pay a lot more waiting to try to get that deal than you would if you just bought in right now. That's based on the data. And so we're informing our clients about that stuff as it's happening. Okay. One of the things that I can tell too by looking at this, and we saw this a little bit in 22 and 23, is a little bit of softening, or it was leveling out. So I saw appreciation at one point in time went all the way down. I think it was like 2 or 3%. So at that point in time, I could see that, hey, we went from that straight bull market coming out of COVID to like we were kind of leveling off. And it was like, okay, now it's time to kind of pause and say, okay, we're starting to level off. But what happened here at the end of last year is we're starting to go right back up again. And so the beautiful thing about real estate is that it is slow to rise and it's slow to fall. So I can continually look at these metrics month over month and be able to tell what's going to happen in the near future, right? I don't have a crystal ball, but I can track the direction of where the market is going. A big mistake that people make is they assume that the last down cycle in 2008, that the real estate market crashed overnight. That was not the truth. That's actually a myth. What happened was the financial markets crashed overnight. You had financial companies like Lehman Brothers that closed their doors overnight. You had stocks go to zero. You had companies go bankrupt overnight. The financial market collapsed. What happened to real estate is it started a downturn. All of that stuff started a downturn in 2008. And we actually didn't hit the bottom of the real estate market until 2012. So it took 4 years from what happened in 2008 for real estate to bottom out. And so what I like to do is use that as a visual that, hey, if you're looking at the numbers every month, you're going to see when that market turns around and when it starts heading down. And then you can make a conjecture based on what direction we're pointing in, how to strategize, how to inform your clients, what strategies to change, what strategies to use, and stuff like that. So Tracy and I, we just bought a couple of flips, and we could be very aggressive with our offer prices because we can see that the market is going up. There's a very good chance that in 6 months when we finish these rehabs and put them on the market, we're going to make 20, 30K more just because prices are on the rise, right? Versus if I saw that the market had turned around and started coming back down, we'd be much more conservative when we're going to put offers in on rehabs or something like that. One of the things I'll tell you that in 2012, I wasn't in real estate back then, but I studied a lot of the numbers because I was really nervous about investing in real estate when I did. And so I wanted to see what happened data-wise in 2008 to 2012 so that I could be prepared for something like that should it come again. And so in 2012, the market here in St. Louis had 14.2 months of inventory, okay? So we're way over here, and right now we're at 1.6 months. So all these people screaming online that the market's going to crash and crash and crash and we're going to burn like 2012, like we're like, we need a 900% increase in inventory to get to that type of market again. Like, yeah, I don't know where all that inventory is going to come from. right? The builders are still behind schedule. As you know, 2008 affected new construction very much, and it's been said that we need about 3.5 million new homes constructed every year in the United States just to keep up with the ongoing need for housing, and they're still not at that level yet. They still haven't gotten back up to 3.5 million homes. So we're constantly at a deficit when it comes to housing. Everybody's going to have a need for real estate for the rest of their lives. They're not making any more land. It's a scarce resource and honestly one of the best investments you could possibly make.